The current live price for Cipher Mining Inc., Nasdaq CIFR, is $22.73, reflecting an enormous intraday surge of approximately 21.88% as of 1:14 p.m. EST today, November 3, 2025. The share volume on this move, nearly 100 million shares traded so far, tells a story far beyond a simple crypto miner catching a Bitcoin tailwind. The common expectation for a Bitcoin mining stock like Cipher Mining is that its fortunes are almost entirely tied to the price movement of Bitcoin itself. It's seen as a leveraged bet on the underlying digital asset. The immediate reality, the deep insight that you didn't see coming, is that this explosive price action today is only partly about Bitcoin. Instead, it's a massive, market-redefining reaction to a strategic pivot that reclassifies the company's long-term business model away from pure-play mining and straight into the white-hot center of high-performance computing and artificial intelligence data center leasing, fundamentally changing the risk-reward profile of Cipher Mining stock. The typical belief in the market, especially among retail investors who might use platforms like Robinhood or are managing their finances through a Schwab Intelligent Portfolio, is that a miner's earnings report hinges on two things: how many Bitcoin were mined and the cost to mine them. So when the Q3 2025 earnings report dropped today, the expectation was a performance check against the consensus estimate of a negative EPS of $0.08 and revenue around $75.5 million. The reality is that the company missed those estimates, reporting an EPS of $0.10, a slight shortfall, and revenue of $72 million. In a normal world, that would send the stock down. However, the market isn't focused on the past 3 months of Bitcoin mining figures. It's focused on the $5.5 billion 15-year lease agreement with Amazon Web Services, AWS, for 300 megawatts of data center capacity to support AI workloads. This deal, along with the prior 10-year AI hosting agreement with FluidStack and Google, which carries a $1.4 billion backstop from Google, is what drove the stock up over 20% despite the earnings miss. This is the ultimate tension between expectation and reality. The market is discounting the operational miss in the legacy business because the future growth narrative in the HPC sector is so compelling and lucrative. The key takeaway for anyone engaged in online investment is that the market is now valuing CIFR as a high-growth data center infrastructure play, leveraging its massive power infrastructure rather than a volatile Bitcoin miner. This sharp, high-volume price surge, taking the stock past its recent 52-week high of $25.11 in early trading, shows a decisive shift in institutional sentiment. Looking at institutional activity, we see that major players like BlackRock, Vanguard Group, and Alyeska Investment Group have significantly increased their positions in the preceding quarter. The institutional ownership percentage, already very high for a stock in this sector, is a testament to the fact that sophisticated capital was positioning for a catalyst, and this massive AWS deal is exactly what they were waiting for. For investors who might typically use a brokerage like Fidelity or a dedicated self-investing platform to buy into traditional tech or real estate ETFs, Cipher Mining now represents a high-beta specialized way to play the secular growth of AI and data center demand. It's a compelling angle that traditional metrics like trailing PE ratio, which is negative due to past losses, simply can't capture. This is where understanding the forward-looking news trumps old-school financial reports. To truly appreciate the pivot, we need to understand the base business. Cipher Mining develops and operates industrial-scale data centers in the United States, originally for Bitcoin mining. Their core competence is securing massive, low-cost power agreements, primarily in Texas with ERCOT, and building modular, scalable data center infrastructure. The model was simple: monetize their power and data center capacity by mining Bitcoin. Older reports showed solid, if volatile, revenue growth, largely dictated by Bitcoin's price and the network's difficulty rate. They have consistently increased their self-mining hash rate, hitting about 23.6 exahash per second in Q3, which exceeded their own projections. However, the profit margins in pure Bitcoin mining are constantly under pressure, especially with the network's periodic halving events. This reality has kept a lid on the valuation of pure-play miners. The new business model, enabled by the AWS and Google deals, is a game changer because it takes that core competence, reliable, large-scale power and facility management, and monetizes it through stable, high-value, long-term contracts in the HPC sector. The contracts with AWS and FluidStack and Google alone amount to approximately $8.5 billion in total contract value over their term, providing an unparalleled revenue visibility that pure-play mining simply can't offer. This is a dramatic shift in company profile, moving from an asset-heavy, volatile operating business to a high-margin infrastructure leasing model. The sheer scale of the announced project solidifies this new identity. Beyond the 300 megawatts with AWS and the 244 megawatts with FluidStack and Google, they announced the formation of a joint entity to develop the Colchis project, a 1 gigawatt data center site in West Texas. They expect to retain about 95% equity ownership, and the site includes a fully executed 1 gigawatt direct connect agreement with American Electric Power (AEP), targeting power availability in 2028. This move instantly places Cipher Mining on the map as a future hyperscale data center player, a sector normally dominated by multi-decade incumbents. They are now factoring in this 3.2 gigawatt pipeline capacity, a figure that dwarfs most of their previous mining capacity and signals an aggressive future strategy. This is not just a tweak to the business, it's a complete strategic overhaul. In terms of future outlook, the expectation now has shifted from Bitcoin price up, stock up, to AI demand up, Cipher mining capacity fully leased. The core catalyst is the execution and financing of these massive data center buildouts. The company successfully completed a $1.3 billion convertible note offering to secure the initial funding. For those interested in investment strategy, the risk is now no longer just Bitcoin volatility, but execution risk. Can they build out the 1 gigawatt Colchis site and the AWS capacity on time and on budget? The current high price reflects the market's high confidence that they can, largely due to the credibility of their counterparty leases with Tier 1 hyperscalers like AWS. A failure to deliver capacity on schedule could cause a sharp correction. On the opportunity side, this pivot allows for sustained growth irrespective of the cyclical nature of Bitcoin mining, giving the Cipher mining stock a durable, non-correlated revenue stream that should command a much higher valuation multiple than its peers. This hybrid model, mining to generate immediate cash flow while simultaneously building out a long-term, high-margin HPC leasing business, is what separates CIFR from the rest of the pack. I want to know what you think about this seismic shift. Comment below with your thoughts on whether you believe Cipher Mining's valuation should now be benchmarked against Bitcoin miners or pure-play data center REITs. The answer to that question fundamentally dictates the long-term price target. For investors using advanced platforms like interactive brokers to track real-time flow, the institutional buy-side volume today confirms that a re-rating has begun. This is a story of a power infrastructure company that used crypto mining to bootstrap its way into becoming a major player in the indispensable power grid that is the AI data center market, a narrative that far surpasses the simple market expectation of a Bitcoin miner merely riding the crypto price wave. The reality is that the new Cipher Mining is a formidable infrastructure entity, and today's stock movement is merely the market catching up to that realization.